In this video, I'll discuss how we can profit from major market trends and their reversals. All of you trading a profitable strategy, but you also need to give you finishing tips trade more easily. Let's go together on a pattern called MTR, Major Trend Reversal. First, I'll translate its name. So, major trend means a main trend, a bigger trend, and reversal is when it wants to reverse. Now, this reversal happens through a series of mechanisms that we're going to talk about together in this video. First of all, keep in mind that before you can spot a major trend reversal, you need to see a ranging situation. In fact, what you see in the image is a ranging state where the price is moving sideways. Ranging can take the form of a flag pattern, or it could be a trading range, or even a rectangular pattern. And after that, you need to see a spike. In previous videos, which you can also see here on the screen, I explained what a spike is and what those candles look like. After you spot the spike, you need to see the second sign. For example, in higher time frames, since you're looking at the major trend. For instance, on the 1 hour time frame. Or on the 4 hour time frame, you might see a series of spiky candles moving upward, and after that, you should see a channel, a CP, or a sign of trend weakness. Whatever you want to call it, maybe you want to see a trading range, maybe a wedge pattern, or maybe just a simple rectangle or a flag. It doesn't matter to me, but the best scenario is when the bullish continuation patterns are in line with the initial pattern. What does that mean? It means if your spike is upward, you should see a bullish continuation pattern where the weakness of the trend is noticeable. For example, how can you spot the weakness in the trend? I'll explain it to you in a couple of slides. It's really simple, but make sure you pay attention. You should see a base or a range, and after that, the price shoots up with a series of spiky candles, and then it starts to show you the trend's weakness. Here, you can probably wait for an MTR, but when does the MTR actually complete? Let me go ahead and explain its different aspects to you. The first thing you need to consider is a weak move in the market. That is, whether you're trading euro to US dollar or the dollar, you see that it's ranging. You've probably seen something like this before news, or before important events in weeks when we have news coming up. You'll likely notice ranging periods, and as news approaches, maybe a day or two before, you start to see upward trends as price moves up to tap into liquidity. Honestly, I'm teaching you from different styles, not just classic price action, so listen carefully to what I'm saying. In the upcoming videos, I'll put all of this together for you, and after you see a series of spiky candles that probably take you right into the liquidity, you can spot the weakness of the trend on the 1 hour time frame. With what element can you identify trend weakness? Let's say you're seeing several tops. If these tops keep getting closer to each other, that's a sign for you that you're seeing compression. You're seeing a compressed move or a squeeze movement. The first top formed here with this much distance between them, and the third top formed here with this much distance. This clearly shows you the weakness of the trend, but what are you missing? Here, what you're missing is the break of the upward trend line, which can happen here, and after that, I want to teach you how to trade. Because up until the last session, you had learned to place your entry position here and put your stop loss behind it. Here are the lows that, in the direction of the uptrend, I'm telling you, you need to watch the videos to understand this. In the direction of the uptrend, the lows can be our first take profit targets. So, this spot can be our first TP. This lower point can be TP2. And these positions are closed with such rewards. If I want to go further, I can say, how can this trend weakness within the liquidity show itself? There are some patterns that you guys know well, like the 3 push pattern. If you don't know it, I'll teach it to you in the future. But if you search for it, you'll easily find it. The 3 push pattern is a structure that's like a wedge or 3 attempts at a certain area, a liquidity zone. And it's really good if, when you're looking at the MTR, we've reached a resistance from above. Or, if you're trading the MTR from below, we've reached a support from below, so that you can see trend weakness happening there. Or for those who work with liquidity, they can see that the price has gone right into the liquidity on the third top. Let me share a few cool, totally experience-based tips about the highs and lows you see in this pattern. The first thing you really need to pay attention to is what we call the area between the second and third top. We call it trend weakness, or we call it divergence. It's a kind of divergence, you see. This divergence between the second and third top can really help you, but I'm not someone who wants to use indicators. so I can teach you a technique that lets you spot trend weakness without them. Look at how many candles it took from the first bottom to the second top in that time frame. 10 5-minute candles, or 10 15-minute candles, or whatever it is. And when you look, you see it's 10 candles here, and then, for example, from the second bottom to the third top, it becomes 20 candles. This shows trend weakness, meaning you don't need to use RSI, MACD, or any of those things anymore. These are really just traps that the market maker sets up for everyone. Forget about them, but come and see the trend weakness on the chart with your own eyes, with your own perspective, with your experience. Try to spot divergence with your experience. And you can use the timing of when these tops and bottoms have formed. Let me erase all this stuff so I can explain this point to you better. Meaning, if from this bottom to this top, for example, it takes 10 candles, and from this bottom here to this top it takes 20 candles, you're clearly seeing the trend's weakness. Because we've made a higher high compared to the previous high, but it took us more time, 20 candles, to do it. But for example, in the previous case, we did it in just 10 candles. So this way, you can visually spot divergence. Anyway, I was talking about how after we ranged, this is the first parameter, we made a spiky move. This is the second parameter, we saw a trend weakness. This is the third parameter. And how can you identify this trend weakness? I mentioned that you can spot some candlestick patterns. You can also look for some schematic patterns. You can even use, waves. I don't know if any of you work with Elliott waves or not, but I don't use them because they're too complicated, so I teach it in a much simpler way. You might see a channel or a wedge that's moving upward in the direction of the spike, and after that, when you notice the trend is weakening, all you need to do is wait for this trend line to break. The moment this trend line breaks, that's when you can increase your confidence in taking short positions. But if you take note of these points, if the first low after that breaks, you can take a short position with even more confidence using a stop loss. That means the first time this low is broken, it should return to this upper range, which I'll explain in a few minutes. But set a stop loss for yourself. And if it comes up here and you see another line break, you can enter again. In these situations, you can also get higher rewards and accept a stop loss. In this strategy, as soon as this trend line is broken, we hit the first low, and you want to trade on the pullbacks and go for a shot upwards. Set a stop loss for yourself so that if this high gets hit again, and if that happens, I have a really valuable tip to share. Only a super professional trader knows these things. If, after this low is broken, the price goes up, it goes up like this and hits your stop loss here, then as soon as this trend line is broken again, you can enter on the pullback to this area, or just like in the previous session's video, enter immediately when this area is broken and take your short position. Actually, it gets better. Do you know why? Because the stop losses for this position are smaller. The two take profits for this position are definitely bigger, because when you were taking a position here or shorting on the pullback from the upper area, your take profits could have been here or here. But if you short from this point all the way down here, you can get, say, 5 take profits, compared to your previous strategy, where the take profit was here, which was 3. Anyway, let's get to the main point. This is a very, very golden tip. This is what I wanted to share with you. Subscribe and like. If you want to know more, stick with me. This area, from top to first bottom, is the edge. We call this area where we return to the trend break, the break zone. So you can take a position in 2 places. Either consider the entire edge area and go short as soon as the price enters the edge, putting your stop here, or wait for it to return to the break zone, where the trend was broken, and then set your stop behind this area. Now, the main question is, what exactly do we see that makes us take a short position? And there's a very clear answer to that. For example, one of the simplest classic price action patterns, which honestly, anyone learning technical analysis picks up right at the beginning and knows well. Like pin bar patterns or candlestick patterns like engulfing, which you can easily spot, and I know you're already familiar with them. Or even more complex strategies, though I'm not saying they're super complicated or weird, but you can use patterns like head and shoulders, for example. So with any of these, I can't get very high rewards. In the previous session, you saw that my reward to risk ratios are between 10 and 11, with a reasonable win rate and many trades, not just 2 or 3. You saw my account has gone up by 100% on my real account, and in this session, I'd like to share FTMO with you. On top of that, I'm telling you that my style is much stronger, But that doesn't mean these other styles don't work. Teaching my style isn't the point at all, because I have no interest in teaching it. Plus, my specific style is just for my own hedge fund. So, what you always pick up from between the lines of what I say is exactly your ace in the hole. Let's move forward. Let me tell you where you can trade. Let's focus a bit. First, you need to understand the MTR. How do you figure it out? I need to give you a few examples of the MTR. I see a ranging move and spiky candles on the 4-hour time frame that are moving strongly, but after a certain point, the trend's weakness becomes obvious. That means the distance between these two tops is this much. And here, the distance between the two tops has become much less. Look at this. First top, second top, third top. It's completely clear that we're seeing trend weakness. So we check a few components. 1, the range. 2, we check these on the higher time frame. 2, a strong spiky move. 3, trend weakness. We have to wait for that trend to break so we can take our short position. But pay attention, if we break this area, you can enter on the breakout or even at the actual entry zone itself, and you can place your stop right behind here. So as soon as it breaks here or here, you can take your positions, or if it comes back to the breakout, you can enter your position here, set your stop behind this area, and set your take profit at each of the lows that helped us on the way up and are clearly marked in the channel. Look at how well it's reacting to them. We entered twice as well. So before it reaches its third take profit, you can short all the upward moves. And in this case, what risk are you taking on? You're accepting the risk of 2 stop losses in exchange for taking 2 trades. It means you're trading nested positions, one inside another. This is something where you're considering taking trades with positions inside each other. Your first position can be on the breakout. The stop loss is here, and you can set the take profit here as well. On TP3, this was TP1, this is TP2, and here is TP3. You can take this position and place your stop loss behind here. And with the take profit you set here, you can short again on every upward move. Suvis returns to break even, your entry point. Pin bar confirmation on lower time frames, 5-minute chart, enter, or an engulfing pattern. Or you can even start trading right away by waiting for a 5-minute trendline break. Get your confirmations this way. For example, 1 hour to 5 minutes, or 4 hours to 1 hour to 5 minutes. You can draw your trend lines and patterns and enter on the 5-minute chart or on lower time frames for advanced. I'll show you example. Example is bullish. Look at the image. Again, we see a ranging movement, and then it breaks out sharply. The spiky candles are completely clear, and now there's a channel, or a wedge, or a schematic pattern that's coming downwards. And from here on, you're just waiting for that damn descending trend line to break so you can go long. Of course, these positions also have stop losses, so don't forget your risk management. Look, when it breaks here, now you're trading the pullback to the break-even point. But let me tell you 2 points that you definitely brought with you from the previous session and already know. You can trade this area using spike, channel, or trading range strategies. We didn't get it, engineer. What happened? Let me explain it to you. In the previous videos, I told you that they always call me by this name. Engineer is a very meaningful name for me because an engineer is someone who builds, and I love to build from scratch, especially with you. Let's get to our topic. As I was saying, you can analyze this area again using some of the patterns I taught you before, like the spike or a channel on a lower time frame. For example, if you're looking at this on the 4-hour chart and you see 3 4-hour candles, then on the 15-minute or 5-minute chart, this is definitely a channel. So you can spot this channel on a lower time frame. Trust me, your eyes will get used to it, and gradually you'll start seeing these patterns really clearly. From here on, you have a trading range. I had told you before, how far can a trading range continue? Let's look at this image to see it more clearly. This trading range, this is one candle, this is the second, this is the third, and the channel's starting point can become the trading range's bottom. If we break that, the trading range can double its size. So, this black candle is twice as big as this section, which is the initial trading range. When it breaks, double its size. What's really interesting is that it came right down to the break-even point, and at the break-even point, you could have taken your positions based on the candlestick patterns you have in mind. Like I said, for example, a pin bar confirmation, and of course, over time, I'll teach you even cooler confirmations, but just know that I always avoid using indicators. To be honest, in my own style, I do have a few indicators, But the reason I provided them is just to make it easier for people who want to work with my style to see things more clearly. Otherwise, those indicators aren't meant to tell you, for example, that when this one crosses that one, you should enter a trade. In my opinion, that's really unfortunate. Let's move forward and talk about spike, channel, and trading range, which we discussed, or the return to the breakout we mentioned. You can trade these right here. The bottom of the trading range has shifted higher. On higher time frames, there's been a major trend reversal, so your take profits can target the 4-hour supply zones or daily ones. And if someone knows about liquidity, they can hold until the FEGs are filled. If you don't know what FEG is, don't worry. Everything I mention in my talks, I'll either teach you in the future or I've already taught you before. But here, I want to talk about the strategy. So I don't want to drag out this session by explaining what FEG is. I'm trying to give you a setup that works and you can figure out its win rate. Make sure to backtest it. Let me give you another example. If you want to see a ranging situation, you can see it here. Then there's a spiky candle afterwards. If you want to draw a precise trend line, you need to draw the lower trend line. Let me draw it for you. This is the difference between a professional trader and a beginner trader, because a beginner trader only sees what they want to see on the chart. This is what's called confirmation bias. They see only what they want to see, and later on, I'll talk to you about these psychological principles as well. Don't be surprised. A trader needs to know all of this. So anything related to your work, you can follow along with me in my channel at every moment, and I'll update all of this for you for free. A professional trader needs to have very sharp eyes. Look, this trend line that you draw here, and it breaks here. If we want to trade MTR, this is basically how it works. We see a range, a spiky candle, then a channel drawn like this. This channel, as soon as it breaks, returns to the point that's the break even. So here, we can take a long position. We set our stop here. Hey, engineer, the stop got hit here. Exactly. And this is exactly what I want you to pay attention to, considering that it had also taken out the first high after itself. The stop got hit here. So a stop is valid for this strategy. You can even, if you're more conservative and looking for less risk, just not trade the MTR at all until after the first stop. And from then on, wait for a spike, a channel, a trading range, or let a candlestick pattern form after this low is taken out. For example, here you can see a confirmed pin bar. Or you could even see this as a spike, see a channel, and on these trading range lows, on these bases that exist in supply and demand. If you know supply and demand, you can go long. And if you don't know it, don't worry at all. I'm explaining it very simply. Let's just risk one stop so we can get to a healthier position. After we took our position here, set our stop here, set our take profit, we got stopped out here. Now from here on, again, we have a trend line that's been broken. Here, it comes back to the breakout point, or it comes back to its own block. You can trade here and set your stop down here. Take profit 1, take profit 2, take profit 3, and the major trend. Remember, we're looking at this on the 4-hour time frame. That means it can also have 4-hour take profits. It's really simple. If I want to give you another example, one of the most famous ones you can see on Bitcoin is when we started dropping from the $64,000 high. And what a drop that was. I remember that no one could believe it. People were saying, how could the crypto market crash? But it really crashed hard. I remember I had a very famous saying, the context is bearish, and every bounce is a chance to take profit. That means every single bounce was ending up in a new low. Even these bounces were just at the top of the trading range, and we kept going like this until we reached the $16,000 zone, where Bitcoin, after taking out a lot of major liquidity, bounced back up. From that point on, the saying changed to, now, every dip is a long opportunity. But how do I come up with these sayings? Come over to the chart, and I'll explain it to you. Look, when you see a ranging phase where the price is moving sideways. Now, whether it's on the weekly or monthly time frame, you then see a very strong move that enters a channel or a wedge. Let me clarify for you what a 3 push, a wedge, or trend weakness really means. Look, this is our first top. Look, this is the second one, and this is the third. I'd like to talk more about the distance between these tops. This is the distance for the first top, and this is the distance for the second top. If I can draw it accurately. Sorry, my line is a bit shaky. This distance is less than this one. So, the fact that this one is higher and greater than this distance shows that there's trend weakness involved. Plus, you can clearly see visually that there's also divergence here in terms of RSI. I'm saying I don't use it myself, But among you, there are people who love indicators, so I have to teach it for them. Look, see how many candles it took from this bottom to this top. And then look at how many candles it took from this bottom to this top. This distance is much shorter than this one. So, the fact that this one is longer than that distance shows that we're moving up with weakness and difficulty. And from there on, what are you missing? Thank you. Exactly. Breaking a trend line and returning to the block area is so you can enter your trades. Or you could even consider the whole range and short that area for yourself with much lower, bigger, and longer term take profits. In any case, those who shorted on the block area might have seen some candlestick patterns here and may have hit 1 or 2 stop losses at this top. On the lower time frames, even at this top and here, when they were taking their own TP from their trade, just look at what kind of TPs it gave them. At least an R of 40 or 50 for those who wanted to hold their position for months. I'm giving swing traders a clue here. I'm saying you can use this pattern to enter your swing positions with the help of scalpers on lower time frames, hold onto them, and enjoy. It's an incredibly cool strategy. I'd love it if you backtest it on gold, euro, Bitcoin, and then come back here and leave me a comment below about your backtest results so we can talk about. And if you have any questions, don't forget to ask. Subscribe and like, because I'll answer your questions in future videos. At the end, I came back really quickly to tell you how you can pass prop with these strategies. Who are you learning from? Let me share something with you. What I passed from FTMO. You can see on the screen the average of my risks in one phase of the FTMO prop, which you know is highly reputable, and I only passed it so you all could see. In any case, I neither need FTMO funding, nor am I looking to get funded by a prop firm, nor am I after any of that, because I have my own hedge fund, my own trading floor, and after nearly 17 years working in these fields, I've set aside my own capital and assets, and I can trade with that. But you can use this situation and this track record to judge whether the person teaching you actually has the technical knowledge for this job or not. If you can scan it, that would be great, because then you can go to the FTMO website and see the certificate right on their own site. But if you pay attention to the details of the trades, even though the average trade and the risk per trade have been, on average, 0.07%, which is an extremely low number for passing a 5%, 10%, or a total of 15% target. It's an incredibly insane number. That means, just to be able to get 5%, you basically have to, if you take hundreds of trades, it comes out to 7%. For example, 70 are you have to get just to pass a 5% target. Getting 70 R is really not an easy task. R is basically the risk per trade, or the risk you're taking in each trade. And if your average risk is 0.07 and the total profit you need to make is 5%, you need at least 70 TPs or 70 R to be able to pass one stage. I want to tell you something. This trader sitting in front of you, I am Amir Hossein Namavar, someone who has been working in this field for many years. In the previous session, I shared my own statement of over $1 million with you. In this session, I am sharing my own FTMO account and statement with you, just to tell you one thing so you can truly believe it. Believe that if you invest time in this path, you can be absolutely sure that you will succeed and achieve your dreams. Buying all those things out there isn't really that hard. When there's a strong person sitting in here, focusing, practicing, backtesting, and remember, I get all this energy from you guys. So if you share your energy with me, rest assured I'll make even cooler videos for you.